Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
All right, welcome to Market Call. I'm Dan Nathan. That's Liz Young right over here. The two of us, just the two of us. Yeah, there you go. Guy Adami still not here. He's going to be back on Monday. You and he are going to do the On the Tape podcast Monday morning.
But wait, it's his birthday today.
Oh, there it is. Deck 18.
I sent him a text.
Deck 18. Did he respond to you?
Am I going to get him in trouble if I say
Maybe
yes?
he didn't respond to me yet. By the way,
I sent him a text and said happy day to the birthday boy. But then I sent a picture.
Old man.
I sent a picture of Brad Pitt instead.
All right. So little known facts. Some of you guys may know this. Guy Adami and Brad Pitt were born on the same day in the same year. Maybe Jacob will flash a who wore it better sort of situation. Yeah. It's not even how it started, how it's going. Maybe a little bit like that.
Well,
all right, so we got to talk about this because in about an hour or so, Fed Chair Powell, they're going to put the statement out, and then he's going to do this presser, and they're going to have a dot plot sort of thing, and that's all happening. All right, so we got a market that's kind of gone sideways of late, at least the S&P 500. The NASDAQ's been outperforming, but we've also seen the Dow Jones Industrial Average. You see that stat? Down 9 days in a row.
I did see that stat.
The longest losing streak since 1978. Talk about, like, you're a strategist. You look at like reams and reams of data, right? You're trying to pick things out and try to make some snappy judgments about it. When you see a headline like that, what do you take away? Especially for a market that is up a whole heck of a lot, but the Dow is massively underperforming the S&P. And
NASDAQ. I think you would be the first person to say the Dow is not a good representation of the market.
But why does it? It's a headline though. Why it was in the journal, it was on CNBC.
I don't know. I think people care about the broad indices.
Yeah.
So here's the thing. My outlook for last year was titled A Cycle for the Ages. And the reason that we titled it that was because of stuff like this. We had broken so many records. There had already been the longest this, the forever that. The last time this happened was, before Christ. Or
right.
And it doesn't seem to matter.
It
doesn't.
What year was that?
BC. The years started counting. It's either BC or AD.
Okay.
So anyway, none of the records seem to matter. So I would actually venture to guess this one probably doesn't matter that much either because it's not down today. So, okay, so it was 9 days.
Well,
now we have a new record.
The day's not over, Liz.
And life carries on.
So by the way, I obviously didn't pay a whole heck of a lot of attention in Sunday school. Okay. I was not a great, Sunday. The idea that I would be in Temple, I'm tribal here, people, at Temple on a Sunday morning was just a heinous crime to me as a young man, as a young boy. Let's pull up a Dow Jones. While we're here, while we're talking about it, let's pull up a Dow Jones Industrial chart. Let's just look at the 1 year if we want to do that. And then we're going to look at a 1 month sort of thing. And again, it's a price weighted index of 30 kind of random stocks. They're not industrials anymore. So if you're a high price stock like Goldman Sachs, and a lower price stock like Apple that just split or something like that, Goldman Sachs is going to have a much bigger weighting in there. Can we pull up that Dow Jones Industrial Average there, please? I just want to kind of just demonstrate. Oh, look at that. That's not a great chart. So look at that. We've seen a lot of charts like that. So that was a very orderly sell-off, nearly about 4%. While the S&P, let's pull up the SPY chart or the SPX for a second. It's been consolidating. Hold on a second. Sorry about that. What is that saying to you? That's 500 stocks. We know that about 10 of them make up 40% of the weight. Now the other one is 30 stocks. And what is that telling you?
Well, first of all, price weighted index is not something to follow because you can manipulate it, right? If you have a stock split, you have a reverse split, it changes everything. And we all know that that's not really what the worth of a company is about. So when we're looking at the S&P, I don't even know that I'd call this consolidation. It just kind of flatlined. It's just sort of going sideways here. It doesn't have a lot of direction. What this says to me is that tech is still doing pretty well. So that's holding up this index. The NASDAQ is doing pretty well, continuing to hold up that index. And this continues to be the rotation of December. I'm not saying this is the broadening out trade. This is the rotation that's happened in December. The stuff that hadn't been the darlings earlier in the year suddenly is the stuff that people want. Now, part of that, I think, is because people have taken gains. They've been trying to reallocate. We've talked about all of this. And I think some of those trends will continue through the end of the year. But look, today, usually I would say this is a really big day. The rate move is all but 100% priced in. So we're probably going to get a 25 basis point cut. It's going again to be more about what he says, what the dot plot looks like, and what their projections are. I think it would take a pretty big mistake today by Powell to really upset markets by that much.
And he hasn't done that.
He hasn't done that in a long time.
Yeah.
Doesn't mean he's a flawless human being.
No, I mean, listen, this one's a bit dicier because we have a president-elect. We have a lot of pressure on him from the prior time that Trump was in office. And so this is going to be a little bit of a dance. Let's be clear about that. And so when I look at the NASDAQ, I look at the S&P. So I'm saying to myself, okay, the NASDAQ 100 is up 30%. The S&P is up about 27%. The Dow that we just mentioned is up about 15%. The equal weight S&P is up about 15%, and the Russell 2000 is up about 14%. So this whole idea of a rotation, the whole idea of the rally broadening out, the breadth has been really bad. Okay, and so that's one thing I'd be really nervous about, because if there are some stories that start to come out, Nvidia's up 4% today on a couple of headlines that I don't think it should be up for, to be very frank with you. And so, it's been a rotation. We've seen, look at that. It just bounced off that 150-day moving average. That was probably where it was supposed to bounce. So let's pull up the SMH for a second. I know we spend a lot of time on this, but the SMH is kind of stuck in the mud. It's been going sideways. I think we have a chart that we put together there at some point. You could say that's a base that look at that right there. So you know how we like to name some formations a little bit? What would you name this? What does that look like?
I think I would call this the hungry alligator.
Well, interesting.
I'm still unclear. We're going more
with, this is not the hungry alligator. This is more, by the way, I coined that. No, this is like something out of the fish family, maybe something that that swims upstream. You know what I mean? Like, no, it's like a bass or something like that. No, it could be a salmon if it was going upstream, because the other ones go that way. But I find this an interesting chart, right? Because you see that downtrend very well defined. There's two uptrends there, right? And so the uptrend that is started from early this year, if you were to break that 150-day moving average and get down, it's about what, 255 or something like that. Is that what we're thinking there? So that might be really interesting. But that's the SMH. To me, it's kind of stuck in the mud. We have Micron today after the close. It's a memory provider. It's a very commoditized sort of business there. We know that memory goes in the servers, right? That goes in the data centers that train the models. So it'd be really interesting. A lot of the previews that I've read, let's pull up Micron for a second here, suggest that they're actually going to miss the quarter maybe, and the guidance that they give for the current quarter may not be that stellar. This thing joined the party, Liz, in the spring. It gave it all back. It's come back a little bit. It's consolidated. How are you feeling about semis in general? Do you think the trade is getting a little exhausted? We saw money come out of NVIDIA at one point yesterday. It was down 14% from its prior highs. Broadcom rallied 40% in 2 trading days. It's kind of giving some of that back here. So how are you thinking about semis?
Well, semis have obviously done well in the last month or so, and since the election, they've done pretty well. I'm looking at the SMH over a 3-month period, up almost 10%, 5% in the last month, and just in 5 days, up 3.5% of that 5% is just in the last 5 days. So there's been some recent strength that I think it was probably time for a little bit of a relaxation of that strength. I think a stock like NVIDIA and a lot of the stuff that has been so popular, nothing has really changed all that much. So a lot of this feels like it happens on technicals right now, and we're waiting until next year to really make a decision about the direction. It's no secret I'm more bullish on software than I am on semis. I remain that way. Software has taken a little bit of a pause, but that's after a huge jump, and we've talked about that as well. When you see those lines that go just straight up, if you just want to pull up the IGV here, if you see that line that goes just straight up so quickly, you're bound to give a little bit of that back. So I think that's a healthy correction that can happen. Now, can semis continue to produce returns in 2025? Sure, they can continue to produce returns, but they're going to need to prove it to earnings, right? They're going to need to prove it in earnings strength and margin expansion, and they're not going to be able to maintain that same earnings strength and margin expansion that they've had for the last 2 years.
Yeah, and this is a point that I've been making, I want to say for a few months now, and I've been wrong about the direction of some of the stocks, but I think this is really important. So Dan Niles, he's been a guest on the podcast here on Market Call, on OK Computer, and on the tape. He runs Niles Investment Management friend. I go back 25 years with this guy. So I think this is really interesting. So he tweeted this, I think 2 days ago on a podcast on Friday. Microsoft CEO said whether he was supply constrained. I am power constrained. Yes, I'm not chip supply constrained. So there was a couple articles out over the last couple of days, basically talking about how Microsoft, the double, triple ordering, now they have as many chips as they need. Okay. We also saw a lot of double, triple ordering out of China. So this is one of the reasons why we saw this tremendous demand, right, for NVIDIA chips. So we saw Meta doing the same thing. We saw Google, we saw Amazon. Now, some of the other headlines is that all of these big customers of NVIDIA are also working with folks like Broadcom, which is that big guidance. They're doing what they call custom silicon. I had a great podcast with Gene Munster of Deepwater Asset Management, dropped today in the podcast store. We talked a bunch about this. So this is exactly the risk to the semi space in the near term because it focuses on NVIDIA. Now let's pull up a Broadcom chart. It comes out AVGO. Liz, when you see this sort of price action gaining $300 billion in a day like that, okay, you have to say to yourself, like, this is not particularly, I don't see that as bullish action. I see that as the sort of action that's very reactionary. It's chasing a little bit. When you see these sorts of parabolic moves, and we've had a few others, Marvel, pull up MRVL, that was 2 weeks ago. Obviously, they were talking about AI and greater share for themselves. I don't see it as bullish going to all-time highs. Talk to me a little bit about this.
So there's a money manager. I'm going to give them a little shout out. I used to cover them. I believe they're still under the Baird umbrella. They're called Riverfront. And they had sayings about their philosophy and process. Some of these are not theirs in particular, but don't fight the Fed, obviously. Don't fight the trend, but then beware of the market at extremes. So when you see moves like this, that's an extreme, right? I don't even care what the name is on the chart. It doesn't matter what the ticker is. Doesn't matter.
Make it 5 years because I think this,
that's an extreme. So you have to beware of extremes, especially when they happen that quickly. And obviously there's a gap there. We know what usually happens to gaps. So you have to be careful here. And I think what we're really at the risk of as investors right now is what sentiment is telling everybody to do. There is still this underlying FOMO, right? Remember when buy the dip was like the only thing people cared
Well, it was
about?
also BTFD.
Yeah, I was trying not to do that.
Freaking, you can say freaking. You can say freaking on this program.
Anyway, that was the prevailing wisdom, was just buy all the dips. And now I think it's just FOMO. It's like, oh my gosh, something went up. Maybe we found the next NVIDIA. So now let's go chase it. And you have to be careful chasing something, especially chasing a chart that looks like that. I don't care what the story is behind it. You got to be careful.
Yeah, no doubt. I mean, sentiment is obviously a very powerful thing. And I think a lot of folks forget it can go the other way too. That's kind of what we had into the end of 21, into 2022. But again, when things got too pessimistic in October of 2022, they started rallying. It was a nice rally off the bottom. A lot of folks, including myself, were still a bit pessimistic, despite the fact that that markets can rally off of oversold conditions. They can sell off over overbought decisions. And then it really comes down to, okay, what's priced in at this point? You know, when I look at these sorts of charts and I hear the guidance that these companies are given, in Broadcom's case, it was long-term guidance. They were talking about a TAM for their chips that they are partnering with some of these folks out to the end of 2027. Well, anything can happen between now and then. And the guidance they gave, Liz, was between 60 and 90 billion. You could drive a truck through that.
Yeah. Well, so if you're buying it based on that guidance, then hopefully your holding period plans to be out until 2027, right? Most investors are probably not going to sit through the gyrations that are inevitably going to come between now and then. And there will probably be some disappointments, not because these companies are in trouble necessarily, not because I think earnings are going to be terrible, but because the bar is so high. How can you not disappoint a little bit? And even if some of it comes in softer in 2025, it is a pullback from the speed that we've seen. So there are going to be bumps, and you have to be able then to hold one single stock through those bumps for what, 2.5 years?
All right, so let's do some math. I know that you're good at it. You and I have spent enough time together over the last 5 years or so. I know that you're good with math. So just think about this. Broadcom suggested 60 to 90 billion, the TAM. Now the assumption based on that move was that they're going to get a lot of that. But let's just say the midpoint of that is 75 billion. Let's just be aggressive and say they get a third of that. Okay. Okay, 25 billion. And that's going to be over the course of 3 years. But the stock just rallied 300 billion based on that long-term guidance, despite the fact that this quarter was not particularly great. So if you're going to do the math on 8, 9, 10 times sale, whatever it is, you would need to discount that back, right? Like, doesn't that make sense?
Right.
So that pop implies 10 times sales for that earnings or that revenue that has not materialized just yet.
Right.
So that seems insane to me. Does that make sense?
Especially because when you're talking about multiples, so if it's, let's say it's 10 times revenue, usually we're talking about that on a forward 12-month basis, not a forward 36-month basis. So people aren't buying that stock right now on a forward 36-month basis, right? And if they're discounting it back, also remember that we're discounting this back at a 10-year that's knocking on 4.5 again.
That's right.
So the price today probably doesn't make a lot. And this goes for any stock. I'm not just saying this about this one. I want to be very clear.
Yeah.
Under those conditions, if that's an expectation for 36 months out or so, the multiple today is usually a 12-month multiple. Keep in mind the discount rate right now is probably higher than it's going to be 36 months from now, I would imagine. So you're discounting it back. This stock price today is probably a little inflated on a lot of fronts.
Yeah, and
right?
you're not suggesting
sectors.
anything about this company's fundamentals. We're just doing a little math based on what just happened. And listen, why are we spending so much time on this? This is the sort of stuff that I think is very helpful to do at home when you're trying. Listen, if you're a trader and you're playing momentum, have a ball. You know what I mean? Because the stock gapped up. It went up 24% on Friday after the guidance. It gapped up on Monday. It closed up 11%. That was a great trading vehicle. Hard to short. You know what I mean? Like if you had shorted it yesterday on the close, you're making some money today. So if you're in and out, amazing. As I think about companies and the guidance that they give and the price action of the stocks, like this is the way like folks like us think about it, right? And so right now, this is discounting nothing, Liz. So all right, we spent a little time there. Let's look at the 10-year yield. You just mentioned it's knocking up on 4.5%. I think a lot of folks who are in the kind of rate cutting cycle. Now, obviously, we had 50 basis points in September. We had 25 basis point cut in early November. Now, Fed Fund Futures, the CME Fed Tracker is suggesting a near 100% probability later today. And then the question is, let's go to January. What are the expectations for a cut there? So let's just say we get out of this meeting. Let's say we get out of the presser, we look at the dot plots, and it doesn't suggest one way or another a strong sort of view. Where did the 10-year yield go?
Well, right now, the January probability is about 18% of a cut. Everybody is expecting the Fed to pause basically.
Which is where it's been, right, for the last 2 weeks.
I think it was at 12 a couple days ago, so it's gone up marginally. Mario and I were talking about this before I came here today. We've also heard a lot about what would be called a hawkish cut, right? So they're going to cut today. What's a hawkish cut? A hawkish cut, in my opinion, would be they do cut today, but the dot plot for 2025 comes out as a bunch of different votes, maybe even 1 vote, 2 votes that have only 1 cut or 0 cuts priced in. Maybe there are a bunch that are at 2 cuts. Maybe there are a couple at 3, but that would be a hawkish cut, meaning 2025 seeing somewhere between 0 and 3, right? So the expectations, I think, if that's the case, and if we get the SEP, the Summary of Economic Projections, that shows the Fed expecting a lower unemployment rate, a higher growth rate, a higher inflation rate, if they adjust all of that in those directions, I think you do see a rise in the 10-year yield. Now, remembering the 2-year yield is what reacts more closely to the Fed. It reacts to monetary policy. The 10-year yield is going to react to economic prospects out in the future. So if things are expected to be better, you see it rise. You see it fall if things are expected to be worse. So if the Fed comes out and says, we think growth is going to be stronger, unemployment's going to be lower, I think the market interprets that positively and the 10-year rises. But here's what I would say about that for the market.
Stock market.
The stock market. This is what happened last time. We got to 4.5%. Stocks didn't like it. So if we get to 4.5, now we've given a little back today. We were up at, I think, 442 at one point earlier today. We're back down below 440. But if we get to 4.5 or even surpass 4.5, I think equities start to wobble again. And that area between 4.5 and 5 is going to drive, in my opinion, is going to drive volatility in stocks. So I don't see it getting past 5 because I think people would get too nervous and drive it back down.
All right, so let's bring it to the stock market. Let's pull up the home builders. Let's look at the XHB. So it's just the inverse of what we just saw in the 10-year yield, right? We saw that move from 4% to 4%. That happened pretty quickly. You see the sell-off here in the XHB. So obviously a headwind would be higher rates because it makes, housing less affordable. Double top, move back towards that 150-day moving average. You see that kind of support range or so. So this is a group, Liz, that's basically suggesting exactly what you just suggested, right? Is that if we get this hawkish cut, that means that yields probably have the potential to move higher, especially given what we've seen as far as inflationary readings, that sort of thing. So all that could mean that the economy's fine, that jobs are fine, right? That rates, really don't have to come down too much more because the Fed wants to kind of wait and see. Let's see what happens to inflation. Let's see what happens to employment. Let's see what tariffs or trade war rhetoric we have. Let's see if there's mass deportations, right? So there's a whole host of things that the Fed, it makes perfect sense that they stick around and wait a little bit rather than set it, forget it. So when you see groups like this acting like this, Liz, do you take anything away differently than what I just suggested there?
Not really. I mean, home builders are typically a pretty cyclical sector, but I think if we look back to what we were saying, and we as the larger as a market participant were saying about rates earlier in 2024, I think most people were expecting them to at least gradually come down and release some pressure off of the housing market. That certainly has not happened. I actually put a tweet out today about the housing market because we got some negative data about housing starts. So you're seeing things like this continued relaxation in housing starts. You're obviously seeing completions that are slowing down as well. So there just isn't as much demand in the housing market. There certainly isn't as much demand in housing employment, so construction employment, which doesn't usually bode well for the economy. So when we're looking at this from a shelter perspective, which we know is such a big part of CPI, there's the charts with the construction backlog. You can see there, we've got housing starts in that dark purple line down pretty far. And then this chart that's really important about, we've got the backlog and then the construction workers that are needed. There aren't as many needed anymore. And the other thing that's important to know about this is that construction usually leads the broader labor market by about 6 to 9 months. So if you see a collapse in construction employment, expect there to be a drawdown in larger unemployment. So something to watch. But I think the housing market has been something that has sent mixed signals throughout this entire cycle. If things were so great and cyclical, right, housing should be doing well.
Yeah.
Home prices should be high. But home builders should also be doing well, and they're not. So I think there is some concern about what's going to happen in the economy in 25 because of that.
Yeah, and so Lennar reports after the close. It'll be really interesting to hear their commentary. Let's rip through banks really quickly because I thought this is another sector. If you look at the BKX, this is the KBW Bank Index. It looks a lot like the chart that we just looked at least, of the Dow, of the home builders of this. It's just a really steady, orderly sell-off. KBW Bank Index is down about 6% from those recent highs. Let's go to the XLF. We know that the largest component there is Berkshire Hathaway, so it's down less, 4% or so. There's that big gap. You see it. You see that 150-day moving average that's rising. It'll probably be at the bottom of that gap in the not-so-distant future. I suspect that gap gets filled at some point, regardless of what rates do. And then, Liz, I just want to get your take on this. Not specifically Berkshire, but the psychology around this. I was out to dinner last night with a guy who's a very smart market participant, and he said that he's owned Berkshire for 10 years. And I said to him, when do you sell? And he goes, I don't. And I said, well, does it disappoint you that, Buffett sold half his Apple and it goes up 35% from the moment they said they've done that? And, he's missed out on a lot of this tech stuff. And he goes, no, it doesn't disappoint me because sadly, maybe he steps down or maybe some other stuff happened. The guy's 90 some years old or whatever. And I said, is that something that kind of shakes, the fear, shakes some fear into investors? And he goes, probably not, because the guys that are heir apparent to him, they probably will not miss out on some of these trends. Does that make some sense to you? Why like a stock like this, it is a bellwether for many people. They buy it and they never sell it.
Sure. So first of all, there's no real telling about what the next, I guess, cohort of people at Berkshire will do. I imagine they will want to put some of their own stamp on what's in the portfolio. But the other thing is we're looking at this, as you mentioned, it's the biggest component of the XLF, right? This isn't really a financial by the way that we talk about financials. They own a couple financials, but it's not, it doesn't really operate that way. So I think that this particular stock, because it's really a portfolio of different assets, and the way that Warren Buffett has made his money is based on a lot of value investing, and it's based on buying some of those big industrials. So you could actually look at this as a hedge against those big tech names, right? And a hedge that would go in the other direction. I mean, I think it's an okay place to be, but just don't expect it to do something all that different from, the
What
rest
that's
of
done in
the
the past.
industrial, well, but the rest of the industrials, almost, because that's what a lot of the portfolio
And I guess
is.
given the valuation, given obviously the lack of idiosyncratic, like you just don't own an insurance company, you just don't own
Right.
I think that, again, part of the makeup going forward might be to find undervalued stocks like Apple that have the potential. They've literally bought back nearly $1 trillion. They retired in the last 12 years a third of their shares outstanding. Just think about that and what that's meant for a holding like Berkshire over the last 10 years. Let's get to something that I think is probably going to be interesting to you on the other side of this Fed meeting, and really as we think about corporates and a whole host of things and in general. Let's talk about credit spreads here, what this means to you, what you're taking away from this, because you have some data that's going to be in your report tomorrow. You're waiting to write it until after the Fed. Talk to us about what you're thinking in credit spreads.
Yeah. So when we're talking about credit spreads, we're talking about investment grade and high yield. You can see all the way on the right-hand side of this chart, we've got spreads that are at tightest levels since 2021. Okay. A couple of things to note about that. We continue to ask ourselves as market participants, is the Fed really restrictive? Well, it doesn't seem like they're restrictive according to this. Nobody's really struggling to borrow money. And the last time spreads were this tight, as I mentioned, in 2021, rates were at zero. So here we are with rates very much not at zero and going into a year where we expect the Fed to probably slow down on the cuts, be a little bit more hawkish in their commentary today. So I'm going to stop short of saying that this is one of the relationship problems that I talk about, but this is definitely something to watch. And there's not a lot more blood to squeeze from this stone, really. So if you're looking at buying high yield today or buying investment grade today, it's not because you think you're going to get a ton of capital appreciation, in my opinion, because it's all sort of in there. It's really that you want the yield. And we have to kind of watch this as what I would consider a rubber band that continues to get pulled further and further back. At some point, it might snap. It might boing its way back into a more normal environment for where rates are today. But this is something that I think is sending a quiet alarm bell.
All right. So the alarm bell is bringing it back to the stock market. What if it does, the rubber band does snap back? What is the reaction on the stock market?
Well, you can obviously see some of those spikes over history, and we can figure out where those spikes have occurred, right? We got in 2020, that big spike. Remember, that's when the Fed intervened and said, we're going to start buying ETFs on the open market to make sure that the bond market functions properly. I am not making a call for saying that credit spreads are going to spike up like that and we're going to have this big blowout in spreads. But if they do start to normalize or mean revert a little bit, given the environment right now, you'll see some volatility in equities, and you start to see the correlations between credit spreads and equities go up, particularly high yield. So if high yield spreads start to blow out, that's usually you're going to see a commensurate blowout in equities.
All right, great. So look forward to having Liz. She's going to have her strategy note. You can get it in your email box. Liz, where can we get it? We can go to the SoFi blog. Oh, there it is. SoFi.com/on-the-money. That's where you can get it. Or you just go to the SoFi blog, sign up for it, get it in your email box tomorrow morning. I'm looking forward to that. Before we get to Butters, Liz, I want to hit one thing here. And this goes back to sentiment. We were just talking about this. Let's pull up an alphabet. That would be the Google chart that we have here. There was a headline a few trading days ago. It was talking about this quantum computing advancement that Alphabet had been working on. It was one of their other bets here. They come out with this data that's showing that they solved a problem, or they're about to solve a problem that scientists have been working on for 30 years as it relates to quantum computing. Just go to the Perplexity, look up quantum computing, or go to Google for that matter, and look up quantum computing, and it's going to break your brain a little bit about some of the things and some of the potential advancements and the like here. But look at that circle, that gap. It was 5% on the opening after that came out. Google is a massive $2 trillion plus company. I was shocked by that, by the way. So they have this new Willow chip, and really it's not going to be in production or doing anything for years now. So that was really interesting. That sparked this rally. I want to go to a long-term chart for 1 second here. You see that internal trend line is banging up against it. You see the uptrend. You see the 150-day moving average. I showed this to Carter. He was on the show the other day. He likes it here. I'm kind of taking the other way near term. I think a back and fill back towards that gap would be really healthy. And then you could probably get in there again for the new year. So I just wanted to kind of make that point, but that just speaks to a lot of folks just chasing. Last thing, talk about chase. Look at these quantum names in and around the space. Some of these stocks have gone absolutely ballistic. Let's just pull up this IONQ. Okay, this is just since December 10th. That sort of price action, kind of insane when you think about it. We've seen this before. Stocks like this become meme stocks very quickly when there's a new narrative. So look at what's going on there. Wow. You can look at all those other names. It's about a half a dozen have done that. All right. Lastly, before we get out of here, if it's Wednesday, Liz, not only do we have you here, okay, but we have John Butters. He is the Senior Earnings Insight Analyst. We don't have John here, but he's over there at FactSet. He puts out this report every Friday morning. You can have it also in your inbox. You have a great inbox based on the market call and the folks that we deal with. FactSet.com/insight/subscribe. Go there, subscribe to it, get it in your inbox on Friday. Okay, let's look at what John's seeing here. We're spending a lot of time talking about estimates for 2025, and then we're going to start spending some time on 2026 very quickly. But I want to get your take on this, Liz. Okay, so this is Butters. This is his work. Analysts expect year-over-year earnings growth of 15% for the S&P 500 for 2025. All right, interesting. You and I, we've been tracking this 2025 number. It's been going up a little bit. I think it was like 6 months ago, 12%, then it got to 13%. Now here's the consensus at 15%. John also put out some data a couple weeks ago saying that on average, strategists overestimate 1 year out EPS estimates year over year by 7% or so. So what does this mean to you right here?
Well, I think even if it is overestimated by 7%, we're still in a good place. And when you look at what CEOs and CFOs were saying coming into 2024, I think they were a lot more cautious because they weren't sure what the environment was going to be for hiring. And it seemed like hiring was going to slow down, which it did. But there's always that concern of, if we have to slow down hiring, do we actually have to start laying people off? And is it going to start eating into our margins? Wage growth was still a little high. Inflation wasn't quite under control yet. We just weren't convinced that everything was okay. So CEOs and CFOs were much more cautious going into that year. This year, I think some of the cautiousness has come off. And I think that maintaining margin growth looks like it's going to be easier, right? Not easy, but easier because we've got a friendlier environment. So I think some of these estimates are reflecting that. The only thing I would say is that we'll be in the third year of this bull market if things continue in 25. Are we going to have another year where Infotech and the Mag 7 are the ones that lead earnings growth and lead everything? It's possible.
Oh, it's the only way you get to 15% year.
It's the only way you get to 15%. That's for sure. But it's also, if we're talking about this broadening out trade as the bullish reason for things to do better,
I'm not talking about it, by the way,
in 25, then you actually have to start focusing on some other sectors. And I would actually look at that chart, the sector chart, and say, still, the most interesting thing to me is that healthcare is number 2 on that list, right?
And it's massively.
It's almost like I'm not even looking at tech anymore because that's just a tale as old as time. Healthcare is number 2, industrials number 3, materials number 4. I mean, some of these I think are pretty good opportunities for people that are looking for growth in places that don't feel as frothy.
Right. And to your point, all 11 sectors are projected to report earnings growth. 6 sectors are predicted to report double-digit earnings growth. The Mag 7, by the way, Liz, because Broadcom is now $1 trillion market cap, I'm calling it the Fateful 8.
Oh, yeah. I heard you do that the other day.
You were watching Fast Money on there?
Yeah.
I coined it, by the way.
Oh, okay.
And so what's really clear to me about that is that, the market, the fate of the market is in these 8 stocks.
Oh,
that's where I'm doing. And then it's a play on
literary
the hateful 8. Remember the Tarantino movie? Okay. So the Mag 7, I'm just going to give it to him right now because Butters hasn't gotten the memo yet about the Fateful 8. I'm going to make sure he gets it. Companies are expected to report growth of 21%. That's what you and I were just saying, down from 33% expected in 2024. The other 493 companies are expected to report growth of 13%, up from 4%. So that's how you get this kind of rejiggering of, you can take down the Mag 7, you notch up the other sectors. There's your broadening out trade if it happens. I'm kind of a seller of that. But just wanted to get this all out there, especially as we head into year end. As we start the new year, we're going to start talking about 2026. I can't wait, Liz. All right. You got your Super Bowl. The last Super Bowl of the year. That's the Fed meeting. We got to get you down to the SoFi offices. We really appreciate you being here. This is one of the last market calls with the two of us for the rest of the year, but you're going to be back raring to go.
The last one.
Yeah. Is it really?
Because next Wednesday is
Christmas. And then the next
Christ's
one. Yeah. And then the next one is New Year's.
Yeah. And I'm not working either.
Thanks, Liz. We've had a great year together. You've been a great partner, and we appreciate being a steward of the SoFi brand. So we love the brand. We love you. Get your money right. All in one market call. That's what we kind of did here today. Did you see that?
Yeah. I'll
Don't tell your. Yeah. Don't. No. Don't do that. Maybe they missed this part. All right. Well, thanks to John Butters and all his fine work this year. Thanks to Liz Young. Thanks y'all for being here. Enjoy the Fed. We will see you here tomorrow. I have a very, very special guest with me tomorrow. You're gonna have to show up and see who it is. We're not even gonna tell you, but it's gonna be a lot of fun. It's me and this other person. So thanks for being here. We'll see y'all tomorrow.